Welcome to Finding Your Way Home, Real Talk on Real Estate. We are recording today for both the radio and for long-term content, and I have a guest in the station with me today. Karen Matthey's with us. She's a reoccurring guest, and she is an expert in the mortgage market. She's one of the owners of the Mortgage Professionals and a mortgage agent herself. So welcome, Karen. Thank you for being with us today.
Thank you for having me. I appreciate it.
We're really excited about what we have to share today because this is really important information for City of Kingston and Frontenac residents. And we are going to take a really long deep dive into the home ownership support program that is coming open again every year. The City of Kingston opens this program, and it is for support for lower income households to get them into home ownership. And technically, I'm going to let Karen tell all the details, but it is a 20-year interest-free forgivable loan. And you can get up to $37,500 to put towards the down payment on the purchase of your first home. That's all my buzzwords. The rest is going to be Karen.
So I think this is such a great program. And the surprising thing is not a lot of people know about it.
Right.
It's kind of like a little secret in Kingston. So the City of Kingston has this fabulous down payment program where people who are renting in the City of Kingston or County of Frontenac or first-time home buyers can access, as Shari said, up to $37,500 towards down payment on a home. Now, there are a lot of criteria you have to meet for this program. But if you meet them, it is an absolutely fabulous way to get yourself kind of on the ladder to be able to buy a home. And it's such a great program that I think it's going to be important to listen today. And if you have any questions, come to Shari or myself because we can kind of help you get started in the process.
Oh, absolutely. I was just going to jump in and say that the applications became available on March 16th.
Correct.
And you actually have to be ready to submit your application on April 1st. And there's a lot of prep. And a lot of documents you have to prepare, which I am going to hand it back to you for that.
Correct.
But there is a full process. So maybe you could walk us through the process. I know you've helped some people get access to this program in the past. And so you can talk about like the technical criteria, the application process, and maybe some stories of some people who've benefited from it.
For sure. So the first thing to note is that it is a first come, first serve on April 1st.
Okay.
So the first applications that get in the door that are complete and accurate and have all their documentation and are approved are the first ones that get into the program.
Okay.
So in order to have it, you have to fill in a completed application, standard things, name, date of birth, social insurance number, address, all of those things. You have to provide, there are income and asset restrictions on this program. So a single applicant cannot make more than $95,000 of income. And a household, as in two or more adults buying in the same family or group, cannot earn more than $130,000 of employment income.
Okay.
They cannot have more than $50,000 of assets, but how those assets are defined. So, for example, things like your checking account would count, your savings account would count, your TFSA would count. But if you have money in an RESP, like a kids education savings program, or RRSPs, those funds don't count.
Okay.
Okay. So there are a few tips and tricks to manage that when I get clients that may be slightly above that threshold to manage sort of how those funds are allocated so that we fit the program criteria. You have to prove all of these things in the application. So you're going to have to provide bank statements and investment statements. You're going to have to provide your tax documents and some of your income documents to show what you make. You're going to have to provide proof that you are a resident of the City of Kingston or County of Frontenac for the program. You also are required to have a pre-approval.
Okay.
You have to have a pre-approval from a bank or regulated financial institution showing that you qualify to buy, because one of the key criteria is the home. You can buy a home that's no more than $500,000.
Okay.
Right? So you can buy a home that's no more than $500,000. So you need a pre-approval for a purchase price of up to $500,000. It can be under that, but up to $500,000 with that down payment of $37,500, for example. The other thing that I think is really important is you do have to have the savings for your closing costs.
Okay. And I know we talked about this before, but maybe repeat, what do you estimate those at normally for people?
Great question. So most of the time for purchase, we're going to average it and say an estimate of 1.5% of the purchase price. So for a home of up to $500,000, I would say, the calculation on that is $7,500. I'd say if you had $5,000 to $6,000, you'd cover the bulk of it.
Okay.
And those closing costs, just to give you an idea of what they are legal fees. You have to pay a lawyer to purchase. a home inspection, which, by the way, is required under this program. You
Oh,
are
good.
required to have a home inspection.
Good.
Okay.
You should always.
Absolutely.
Just for the record.
Absolutely. And land transfer taxes. Anytime you buy a property in the province of Ontario, the government is going to charge you a tax. As a first-time home buyer, you get a rebate towards that of up to $4,000. But if you're purchasing at $500,000, that rebate's not going to fully cover that tax. You're going to have a portion of it owable. So we've had quite a few clients who benefited from this program. Had a young couple 2 years ago, actually, who met the criteria. We did all the work a month in advance. We had everything ready to go. I don't know what number they were, but they had to have been in the first 5 that got in there.
Good for them.
Yeah, I'm pretty sure he had that email going at 2 a.m. On the day it was open. So they were very lucky to get approved. Now, when you get approved, you have 90 days to purchase a home. Okay. It doesn't have to close within those 90 days. When I say close, the home doesn't have to actually be officially purchased within those 90 days.
Transfer of title.
Keys you actually
hands.
get the keys. Exactly.
Yeah.
So if you find a home on day 82 and it's closing after the 90 days, that's okay. They actually were a couple that found their home, not quite day 82, but they were 2 months in because they really were searching. And at the time they did it, I think the cap was $440,000, I think, on the purchase price. So they spent some time. They really looked for the home they wanted and put their offer in. It was accepted. We went through the program. The down payment was delivered to their lawyer on closing day. They had their closing
from the
costs.
city.
From the city.
That's wonderful.
Yep.
Okay.
And so now they are very happy in their home. They intend to stay there for quite a long time. But I think that's another criteria of the program that's good for people to know. It's a 20-year interest-free forgivable loan. If you keep the home for 20 years, you don't owe anything.
That's fantastic.
At the end of the 20.
You don't pay the money back.
Correct.
Right.
However, if during the 20 years you sell the home or you do something that is against the program rules. So one of the things would be if you moved out of the home to rent and rented the home out. You cannot turn the home into a rental.
Okay.
Or vacation property or an Airbnb or things like that. Then you do have to pay back the loan plus 10% appreciation.
Does it impact at all when you refinance in the 5 years?
Yes and no. That's actually a great question. It does in the sense that essentially the city of Kingston is a mortgage holder. Yeah. Right? They're sitting behind your mortgage holder. It is a consideration for some lenders if you are changing lenders. So by refinance, what Shari means is if you've owned the home for 4 or 5 years, and let's say you want to do a large renovation, you want to redo the kitchen and the bathroom, it's going to cost $60,000. So you're going to go back to the lender and say, hey, can I borrow an additional $60,000? The home has now increased in value. Right. So I have some equity there. Can I take $60,000 out of the home value to renovate? The city of Kingston in that case has to agree to be subordinate to that lender. They have to agree to be in second position behind that lender, which again, traditionally for all the programs the city of Kingston runs where they put a lien on, there are other programs.
The program seems fantastic. And I like to look at both sides of everything. Are there any cons? And if so, what are the cons?
The criteria is tight, right? You have to make just enough money, but not too much money.
Right.
You have to have some money, but not too much money. So the criteria can be challenging for some clients to meet. Getting pre-approved can be challenging. Yeah. You have to have sufficient income according to the program, but not over that. But you can't have I shouldn't say you can't. It is much harder to qualify if you have a significant amount of debt. Okay. If you have a car payment that's $1,200 a month and you're a single income family at $95,000, that's eating up a lot of your qualification. Right. Okay. Right. So that would be much harder to pre-qualify. So I'd say the criteria themselves make it difficult to qualify. Right. Again, that's not a knock on the city. I think this is a great program, but the criteria do make it difficult to qualify. They do have a line in there that you can't use the funds for renovations, which I understand, but there is a program called Purchase Plus Improvements. Yes. Where you can buy a home and use mortgage funds to renovate. I don't know if that counters the city's program. So I don't know if you could do that program under the city's down payment program. So that is a question I actually have for the city is whether or not people, because if you found a home that you really loved that was $480,000, right, and you wanted to do $20,000 of renovation, so it's still under the $500,000 mark, I don't know if you could do that program alongside this.
If you're purchasing a single family home under $500,000, it most likely needs renovations. Yes. Because that would be a really great price point for a single family home. Correct. You can get some fantastic semis and some fantastic townhomes that you could move into for that price. And then my other curiosity is about condos. So you can absolutely get a condo for under that right now in the city. There's lots for sale.
Correct.
How would condo fees impact this?
Good question. From the program itself, they wouldn't, but from a qualification standpoint, I often have to clarify with clients, if I pre-qualify you for a $500,000 purchase of a home, that is not a pre-qualification for a $500,000 purchase of a condo.
Right.
Because a home doesn't have condo fees. And condo fees can be anything from $350 a month to $1,000 a month. If you buy a condo with a $650 a month condo fee, that is eating into your qualification. So I might say to someone, you are pre-qualified to buy a home for up to $500,000. And using an estimate of a $500 a month condo fee, you can buy a condo for $465,000.
Right. Okay.
So the price point at which you can buy a condo is lower typically than the price point you can get pre-qualified to buy a house from a mortgage point of view.
Okay, that makes perfect sense. So if you wanted people to remember 3 specific tips for being successful applying for this program, what would those be?
Get your documents ready early. Go get pre-approved sooner rather than later, because that process can be very quick, but also if you've got things we got to alter or amend in your application, we got to fix a credit issue or an error on your credit bureau, all of those things can take time. So get your documentation ready, get pre-approved, and do this now.
Right.
Start doing it now, I
well,
should say.
and Karen won't say it, but I will say for her, you should absolutely visit with and meet with a mortgage agent, preferably Karen, who has been through this program and has the experience working with the city programs.
Yep.
Because there's nuances, as there is with everything. And so you absolutely want to make sure that you're not missing anything. Or, in a lot of circumstances, you forget to submit one paper or you forget to dot one I or cross one T. You can suddenly become ineligible. And it's not, like you were saying, like an unlimited pool of money. There is only a certain amount of funds set aside. And once it's used up for all of the successful applicants, then it closes again for the year.
First come, first serve.
Right. Okay. And interesting because it is tax season at the same time. So you should have your documents readily available that you're doing your taxes anyways.
Correct.
Why not apply for an incredible program like this, which is, it's just so much support from the city in the beautiful city that we live in. Does it impact your mortgage rate if they know it's backed at all?
Nope.
No?
Nope.
Okay.
I will say this. Not every mortgage lender accepts this as a form of down payment, but the majority do.
Okay.
So yes, maybe there's some lenders who will say to us, we don't accept that. Not very many though. Most of them now have a comfort with it. The program's been around. They know the city. Now that the city has all these other programs,
Right.
they're quite used to the city taking a second position lien. So yeah, so most lenders are comfortable with the program, but not every lender.
Right. What is a current average mortgage rate that you're comfortable to share? And where do you see it going this year?
In terms of rates, you have a couple of different buckets, let's call them, of rates. You have insured rates, which are clients who buy with less than 20% down payment, get a CMHC insured mortgage. They get a mortgage that is essentially backed by the government.
Great.
If they stop paying their mortgage, CMHC, which is a Crown-owned corporation, so essentially I'm going to call it the government, will step in and pay back the lender.
Okay.
So those rates tend to be the best rates you get in the market because CMHC-backed loans are essentially government-backed loans.
There's no risk.
So if you're a lender, why wouldn't you want to lend to somebody who the government is saying, hey, by the way, if they don't pay, I'll write you a check.
Right.
So those rates are the best rates out there. They're rising right now on the fixed side, but they're sitting sort of, let's say, at or around 4 or so percent. Currently rising, and I'll explain that in a moment. The second bucket, or second and third bucket, are non-CMHC insured loans. So those could be purchases with 20% down or more. Those could be refinances. Those could be renewals where you're switching from one lender to another. And those rates can sit anywhere from sort of low 4s to mid 4s, depending on where you're at. You also have variable rates. Can
you talk the difference? Because I'm not 100% sure that fixed versus variable is necessarily common. So if we can go back to basics and just describe the difference, that'd be great.
For sure. So fixed rates, you're guaranteed the rate for the length of the term. You could do a 3-year fixed, and then in that case, for 3 years, you have the rate, the rate doesn't change.
It's not changing, which means your payment doesn't change.
Correct.
Perfect.
Rate and payment stay the same.
I can plan for 5 years.
You have cash flow planning. You know what you're doing. 5-year fixed, same thing. Doesn't change. You have a longer time in that case of guaranteed sort of certainty with your rate and your payment. And fixed rates are they move alongside sort of market bond yields in the market.
Okay.
So I typically say they're controlled by bond. They're not controlled by bond yields, but that's the metric banks use. If bond yields are 2, banks might say, I want bond yield plus 2, so I'm going to price it at 4. If bond yields go to 3 and the bank still wants bond yield plus 2, now mortgage rates are 5.
Right.
So when bond yields go up, fixed mortgage rates go up. When bond yields go down, fixed mortgage rates go down.
Okay.
Variable rates, on the other hand, I like to say are controlled by a group of largely men who go into a meeting room 8 times a year with a bunch of briefcases, and they sit and they discuss inflation and whether or not the Bank of Canada should shift or move the prime rate, whether or not the Bank of Canada, essentially, it's called the overnight rate, but they should essentially move rates up, rates down, or stay the same. They meet 8 times a year. And that is the only time typically that variable rates move.
Okay.
Is when the Bank of Canada decides, the governors of the Bank of Canada decide to move it up, to move it down, or keep it the same. So you can argue that variable rates are human controlled.
Okay.
As opposed to like a market dynamic that moves and shifts with a market. And the Bank of Canada's mandate, sole mandate,
I love
by the
this
way.
when you talk about this. This is so well explained.
Of the Bank of Canada is inflation. That's it. The U.S. Fed has a couple of different mandates that they have to, okay, we want you to, do inflation, but we also want you to watch housing and jobs and all these other mandates. Bank of Canada says all we care about from the perspective of rates is inflation. If inflation is high, we are going to try and use the only mechanism we have, which is rising rates, to control so people buy less and inflation comes down. It's slow spending.
Okay.
If inflation is very, very low, and the economy is in great condition, they might just stay. They might just stay where the Bank of Canada rate is because they think we're comfortable there. But if inflation is low and the economy is really struggling, we're in a recession, we're losing jobs, etc., that's when the Bank of Canada will use the mechanism to drop rates to try and push the economy, stimulate spending. People have more money in their pocket.
Where would you say we are right now? Recession versus...
We are in a mid-inflation market, so inflation's not bad. It got as high as 8 during the pandemic, and it's hovering just under 3. But there's 2 things that have happened, and this is why I want to go back to fixed and variable that are impacting. 2 things that have happened recently. One is the war, whether or not you call it the war with Iran.
Right.
What is happening with Iran? So that's number 1. Number 2, what is happening with oil prices, gas prices. So what's happening with Iran shoved bond yields upwards 0.3%. That's a pretty significant move in about 6 days. Mm-hmm. Very significant. So what we saw was mortgage rates start to rise. Fixed mortgage rates. Sorry, I'll clarify. Fixed mortgage rates start to rise. At the same time, we saw gas prices sharply push up.
Oh boy, yes.
Now, when gas prices rise, that impacts inflation.
Yes.
Right? Now, the impact is not immediate because the inflation is what we call a lagging indicator. They measure inflation today, but it might not show up in the numbers for 2 months. But we know it's coming.
Right.
We know it's likely that inflation is going to go up. So if you asked everybody a month ago whether or not they thought the Bank of Canada was going to cut rates, keep rates, raise rates in 2026, half of them said stay the same, half of them said maybe a cut.
Right.
Now, half of them say stay the same, half of them say maybe a hike.
Okay, interesting.
So things can change very, very rapidly, and things could change a month from now, and it'll be a different view as
well.
The
world is quickly changing.
It's very quickly
you wake up every day and don't know what to expect.
Correct. So fixed rates right now are higher than variable. Variable, I think right now the Bank of Canada meets on March 18th. Most people expect them to keep rates where they are because we haven't seen inflation shift yet. We haven't seen the numbers shift yet.
Right.
The economy's not doing fantastic.
I heard some really not great
Jobs
employment
numbers.
Statistics today.
Not great.
Which were really not great.
Not great at all. But up until now, we've actually had, ironically, some interestingly halfway decent job numbers. But the economy is not growing. Right. And so I'd say the Bank of Canada is kind of torn between they may want to cut rates to stimulate the economy, but they can't if inflation is a concern.
Right. So if I'm a variable rate holder, we talked about if I'm a fixed rate holder, I know what my payment is going to be for the next 5 years consistently.
Correct.
But if I'm a variable rate holder, my payments can change. And then every so often you get a letter in the mail, because I had one for a while, that said, guess what? Your mortgage payment's going up because the variable rates changed. So can you talk about that in more detail?
Yes. So when the Bank of Canada governors meet that 8 times a year, that's when they can shift rates up, shift rates down, or keep them static. And so you as the borrower are vulnerable to those shifts. Now, if they bring the rates down, great. the rate of your mortgage goes down, but so your payment does too. And actually, I should clarify. There are what we call static payment variables and changing payment variables. I'm not a huge fan of static payment variables because they hide what's actually happening in your mortgage, positive or negative.
Right.
If rates are going up with a static payment variable, you can end up in a position where you're paying less and less and less principal and more and more and more interest. And for some people, post-pandemic, they went backwards on their mortgage.
Ouch.
Their payment did not even cover their interest.
Oh, boy.
So the static payment variable, not a huge fan of. The changing payment variable, I think, is a more real view of what's happening in your mortgage. And so if the Bank of Canada raises rates, your rate goes up, your payment goes up.
Okay.
If the Bank of Canada drops rates, your rate goes down, your payment goes down.
Say, for example, my mortgage payment is $1,000 a month, and I'm in a variable rate mortgage, and I get that letter that says your payments are going to drop because the variable rates have dropped. I've opted to keep my payment at that $1,000 because I was comfortable and I could budget for it and I was planning for it, which then meant more of my payment was going towards principal.
Correct.
Which is a good thing if you can tolerate that.
Absolutely correct.
Right.
You absolutely have the option to say, hey, I'm comfortable with where it was.
Right.
And I want to accelerate the pay down of my mortgage. In other words, if my mortgage has 25 years to be paid off and I'm paying more principal, maybe I've just cut 2 years off of that. Maybe now it's only 23 years I got left to pay this mortgage off.
That would be wonderful. Okay. I also wanted to go back to, I was thinking while you were talking about qualifying. And so are we still doing a stress test?
Yes.
Okay. Can you talk about what a stress test is?
So when you qualify for a mortgage, let's say the actual rate you're going to pay is 4%. The regulator requires every borrower to qualify as if the rate was 2% higher than what you're actually paying.
Right.
So if your actual rate on your contract is 4, we have to stress test you if your rate was 6. Could you qualify for that same mortgage if your rate was 6? So when we're looking at the payment you qualify for, we're actually looking at the 6%. 4% is what you're going to pay,
right? But
6% is what we have to, quote unquote, stress test you on.
Okay.
Now, there's some talk of whether or not the stress test is going to be removed, but before people get way too excited, there's other metrics they will use that will sort of replicate the feeling
basically
of the stress
test the same thing.
Yes,
right?
it will be like a loan to income ratio, for example, that will be very similar to what the effect of the stress test was, which is to say we will cap how much you can borrow based on the regulator's fear that if you came up to renewal after your 5-year term, 3-year term, whatever it is of your mortgage, and rates were higher, you would struggle to afford the payment, which is in some areas, I don't think Kingston is getting hit as hard, but there are markets where people bought during the pandemic at extremely low rates.
Yep.
They are now coming up for renewal, and the payment increase on those renewals, they are struggling to afford because some of those mortgages in Toronto were very, very, very large.
Oh, I always talk to my clients and say, like, nothing was natural or healthy during the pandemic, including the insanely low mortgage rates. So say you got a mortgage for 1.9% during the pandemic and it's 5 years later, and now you're renewing at 5.9%. That's essentially 3 times more than you were paying 5 years ago. And some people just can't take that, which is causing part of the flood of inventory on the market right now. So we're very close to being able to officially declare we're in a buyer's market. There's a lot of homes for sale on the market, and they're not moving as quickly as they used to. And this is one of the causes, is that so many people, particularly, I'm going to talk about investment properties, because between that increase in the mortgage rate, you can't increase rent correspondingly to make up the difference. So you might be upside down in an investment property. Yeah.
The thing that's I guess hedging a little bit of that or impacting, the reason I said Kingston maybe is not as heavily impacted as a market like Toronto is that, number one, yes, the rate is much higher, but your principal of your mortgage is also lower though. You've paid, like if you start with a mortgage of $350,000, 5 years in, your mortgage might be $315,000, $310,000. So you're applying a higher rate to a lower balance. The other thing some clients did, at my advice, was they paid accelerated. So they paid their mortgage. They chose to pay a little bit more on every payment. So instead of, let's say, a 25-year pay down of your mortgage, they chose to pay as if it was 22 and a half years. So for some clients who come up to that renewal, we have quite a few options. Number one, their mortgages are much lower than they otherwise would have been.
Okay.
Number two, they can stop or pause the accelerated payment for a time.
Okay.
So I've had clients come up for renewal where their payments have shifted not at all or $100 every 2 weeks. And I'm not saying that's nothing. That is still an increase. but not so detrimental that they need to sell, for example, in those examples. So if you're getting the right advice on how to structure your mortgage and how to pay down your mortgage, and then what we call the payment shock of your renewal,
Right.
we've been able to at least somewhat mute that a little bit for our
Right.
clients.
That's beautiful. Absolutely don't feel like you need to go this alone. And I'm going to admit I did for years. I'm guilty of that, figuring this all out, which we all know nothing of. So get a money team of professionals around you. I don't do anything anymore until I consult Karen or my financial planner, and then we decide what the right move is. And I think we'll have to explore it another time. But your reflex would be, I come into some money, I should pay down my mortgage, which necessarily isn't correct. So whenever that happens, I will not do anything until I call my money team and figure out what to do. Closing thoughts just on, the current market, the City of Kingston program, or any advice for navigating this tricky world we're in right now.
Let's leave on a positive. Kingston's got some great offers out there in terms of properties. There's some great opportunities. And so I think if you're a buyer, City of Kingston down payment program is fantastic. Get yourself on that list. It can't hurt. And if you're looking, get pre-approved. Get, at least know your numbers so that if the right property comes up and the right price comes up, you're ready.
Right. Absolutely. All right. Well, with that, I thank you again for being a guest, and I wish everyone a wonderful day finding their way home.